Understanding how stock markets work. Stock markets are fascinating ecosystems essential for the world's economy. They are places where shares of publicly listed companies are issued, bought, and sold. While often shrouded in jargon and technicalities, understanding these markets boils down to knowing the basics of buying, selling, and the dynamics that influence these activities. At the core of a stock market is a stock exchange. Stock exchanges are venues, either physical locations or electronic platforms, where traders gather to trade shares. In the U.S., famous examples include the New York Stock Exchange, NYSE, and the NASDAQ. The primary purpose of a stock market is to facilitate the exchange of securities between buyers and sellers, reducing the risk associated with investing. Companies raise capital for expansion by issuing stocks, offering a share of the ownership and, thus, a claim to part of the company's profits, and sometimes losses, to investors. There are two types of stock markets: the primary market and the secondary market. In the primary market, companies issue new securities through an initial public offering, IPO. This is the first time a company sells its shares to the public to raise money. Once the IPO is over and the shares of the company are sold to investors, the company becomes public, and its shares start trading on the secondary market. The secondary market is what most people refer to when they talk about the stock market. It's where investors buy and sell stocks they already own. Stock prices here fluctuate based on supply and demand dynamics and various other factors, including company performance, economic indicators, interest rates, and political events. When you decide to invest in stocks, you're presented with various methods. You can use stockbrokers who execute trades on your behalf, or you can turn to online trading platforms, which allow you to manage your investments directly. Some of these platforms offer real-time data and complex financial instruments for more seasoned traders. Stock markets are known for their volatility. Prices can swing wildly in a short amount of time. This volatility is influenced by numerous factors. Economic data releases like gross domestic product, GDP, growth rates, unemployment figures, and manufacturing output reports can all sway market sentiments. Moreover, geopolitical tensions, changes in interest rates set by central banks, and corporate earnings reports are also significant. Interestingly, there are various types of stocks to invest in, such as growth stocks, which offer high capital appreciation potential, and dividend stocks, which pay out regular income. The choice often depends on the investor's risk tolerance and financial goals. To navigate stock markets successfully, investors often employ strategies ranging from buying and holding stocks for the long term to short-term trading strategies like day trading or options trading. Diversification, which means spreading investments across a variety of assets to reduce risk, is a commonly adopted approach. In summary, stock markets play a critical role in providing an efficient platform for buying and selling shares, enabling businesses to access capital and investors to earn returns on their investments. While they present opportunities for profit, the inherent risks mean that investors should approach stock trading with caution and diligence.